Hey everybody, this is Kevin Gormley, CPA that does financial planning with Leading Edge Financial Planning. And today we're going to talk about the second quarter market review. Again, just to reaffirm that Charlie and I do not believe in short-term performance. We believe if you focus too much on short-term performance and you performance chase, usually you end up destroying your long-term wealth creation. That is, being patient gets rewarded in the long run. So what I wanted to do is talk about numbers, but really talk about some of the messages that, once again, we learned from the last quarter, quarter two in 2017. So with that, let's look at some of the numbers. Now, the U.S. stock market was up 3.02% in the second quarter. The average quarterly returns for the S&P 500 is 1.9% per quarter, so this was above average. But as we know with stocks, above average can be a good thing, and then sometimes it can be well below average, and we can have quarters that are just horrible. But the average quarterly return is 1.9%. I'm going to talk about some of the volatility or the lack of volatility that we've had this year in stocks in a second. But again, a good quarter, and it just seems like the U.S. stock market is just chugging along upward, and that could be good or that could be a dangerous thing. So next thing is international developed. Now, what we see in the next two categories is international developed and emerging markets have continued to just phenomenally grow. The last 2 years, after multiple years of dismal performance and people asking, why are we investing anywhere in the U.S.? There's been not only great quarters, but great years. So 5.63 for developed and 6.27 for emerging markets. Really great quarters. And you can see the averages below 1.5 and 3.1 respectively. Global real estate. We do believe at Leading Edge in investing in real estate. 1.67%. This is in U.S. and foreign, and the average quarter has been 2.7%, which is really outstanding. U.S. bond market 1.45, and then global bonds ex-U.S. has been 0.6. So this volatility issue, which is we don't care that much about volatility in the short run. There's really not been a lot of great news in the last quarter that made the market get crazy. When we look at over 2000 to 2016, we see the crash in 2000, we see the crash in 2008, and then we see the mini dip, which at the time it seemed really bad at the beginning of 2016. The message I want to convey is that although things seem to just be steadily upward, is that the risk of owning equities or equity markets is not safer today than it was even before 2008 and the crash in 2009. The risk level is always the same. We don't know when markets will crash. We believe that markets will continue higher over time and will get great returns, but there's always a risk that markets could go down. And there's a risk right now that markets could go down, just as we tell you every quarter. Do we know when it's going to happen? No. We invest to capture the upside, but also to not get too crazy for our risk tolerance based on our financial plan. So that caveat is over. The best performing asset class for the quarter is probably a shocking one. It's ex-US small cap. So it's the little teeny companies that are all around the world that did the best. The little teeny companies all around the world. Now, what has been predicted to do the best? It's been the large US companies, which have done the best the last number of years. That didn't happen in this quarter. Emerging markets have been very hot the last 18 months. Will that continue? I don't know, but it's a lot more fun to own these emerging markets. Again, patience pays off eventually. And then you can see all the other asset classes. The Russell 2000 value is the small cap value, was one of the worst asset classes so far year to date, and it persisted in quarter two. So you can take a look at those if you like. In the U.S. stock growth, the sexy growing companies that everybody wants to own did really superior in Q2 after a number of poor quarters. Again, we believe value will outperform growth in the long run, but it didn't happen in the second quarter. U.S. market now makes up 52% of all the dollars that people are throwing at markets or investing at markets, or the capitalization. It's down from 54%, and that's because international markets did so well the last number of quarters. International developed. Really, the story here is the dollar, and you don't have to understand a lot about currency. The only thing I want to say here is, again, about 2-3 years ago, we started hearing that we needed to hedge foreign investment because the U.S. dollar was going to continue to get stronger and stronger and stronger and stronger. And look what happened in this quarter. If you owned foreign investment in their capital, in their currency rather, you got a 4% return. Those of us, including leading edge financial planning, that did not hedge in U.S. currency actually got a better return. So we don't hedge stocks, we do hedge bonds. That's really the thing I want to mention. So across the board, international did pretty well, but then when it came to us as U.S. investors, it did even better, 7, 6, 5, 4. Emerging markets. Again, the growth area of emerging markets, the sexy companies did 9%. The large companies did 6%, but overall emerging markets did very well. They make up 11% of the world capitalization, or the amount of money that's thrown into investments. So which countries would you pick? Well, we don't pick countries. We pick owning the whole market, but Austria, Denmark, Finland, New Zealand, France, Italy, they were the top performers. Maybe it's interesting, maybe it's not. Australia, I can't say it, was the only losing company in our country in developing markets. When we look at emerging markets, Greece, Hungary, Turkey, Poland, I don't know that these would be the first choice, but they did very well last quarter. So that's, again, why we think you own all the markets in a good diversified portfolio. Currency I won't get into because it puts everybody to sleep. Real estate investment trusts. The global real estate market as dimensional funds looks at it as 60% US, 40% world. This time around, again, global REITs outside the US did better than US REITs. So that has not been the case, though, recently. Commodities. Pretty much all commodities did poor last quarter. And the energies all were down. So fixed income is the last, I think it's the last asset class, and then we'll just show you the 100% equities, 60% equities, and etc. So bond yields across U.S. issuers, the 10-year, the yield was 2.31. Municipals were yielding, municipal bonds tax-free were yielding even higher, and they are tax-free. And then AAA corporate 2.73, 3.32. The yield is starting to become a more standardized yield where you get paid more for having the money in a longer time period, which I think is a good thing. So the impact of diversification, if you were in 100% equities for the quarter, in a 70-30 worldwide portfolio, 70% US, you would have had a 4.45, and then you can see the rest of them. So even a 75% portfolio did very well in the quarter. 100% T-bills, not so much. So where will market rates go? We don't know. And this is just saying, do stocks go down when rates go up? And the answer is not really. So anyway, this is Kevin Gormley for Leading Edge Financial Planning. Thanks for watching. We'll find out what will happen with Q3 and Q4, but really the most important thing is to stay the course, continue to invest, stick with your financial plan, and let your investments really focus on your investments as part of your financial plan. Thanks for watching.